Welcome back, my friends. So look, at the end of the quarter, the end of 2022, it's time to look at the Medical Properties Trust updates. Now what we're going to cover off today is a little bit of the news. We're going to cover off some of the more concerning news. I'm going to look at what I see as being very positive from the last earnings call, and we're going to end with a very special news announcement about dividends and income investing. So stick with me, folks. Hit that subscribe button, and together let's learn to be better investors. Okay, one of the most important things from the recent earnings call is probably the insight that the issues with tenants are just beginning. Now, despite the fact that they've been very successful with Squibb over the last year, I think they've seemed to have navigated that minefield fairly well. They're now also saying in quarter four that Prospect, one of their other key tenants, has ceased rent payments in Pennsylvania. Partial cessation of rent payments in California. Now what this means is they're actually writing off some of that straight-lined rent. Yikes. Okay, so as a result, then the 2023 FFO per share, that's funds from operations per share, guidance is going to be lower than the previous consensus estimates from the analysts. Okay, so what does that mean? Okay, well, the first thing that we need to consider is the way in which hospital labour expenses have risen catastrophically since 2019. So here, 37% labour increases for hospitals since 2019 to the first quarter of 2022. So we're talking substantial increases then in the labour costs for the operators of the properties for Medical Properties Trust. Now, along with the substantial increases in labour costs, there's also been challenges around the difficulty in getting supplies for drugs, for example, the increase in the cost of supplies for drugs, for example, increasing interest rate expenses as well when you think about what the Fed has been doing, and of course the regular rent increases that the landlords such as MPW is going to put on them. Now, is it any surprise then that the number of healthcare sector bankruptcy filings has increased substantially? That's almost doubling over 2021 to 2022. I don't think so. Now, wrap all of this together and it has serious implications for the landlord like Medical Properties Trust. Okay, so it's not surprising then that one of their tenants, even Prospect, is struggling a little bit. It's not their fault, they can be very well managed, but everything basically at the moment, all these macro environmental factors are basically against them. Now, what does this mean for MPW? Well, they're not saying that they're writing it off altogether. They're not saying that they're writing off Prospect. They're not saying that they're writing off the rent. They're essentially saying that, hey, look, Prospect is still a viable company. They've still got valuable real estate. Now, importantly as well, it's not just MPW saying this, but they're also saying, look, independent evaluations have been done by third-party and third-party offers and negotiations, suggesting that the Prospect has a valuable company worth about $1 billion. Now, this is important because they have security interest in this business, and so they believe they actually have plenty of collateral, even without having to sell without the value of the Pennsylvania properties. So they do believe that they'll be able to realize full return on the investment in Prospect, including any deferred rent. So, look, even if it's just a single tenant here, Prospect, they can manage. That's important. I want you to think about that. Even if Prospect has challenges, they will manage. FFO might take a small hit, but it would not be that big a deal. Now, Prospect is, of course, the second largest tenant in terms of the investments that they've made. But it's also important to note that there's other tenants as well. As far as I can tell, many of their larger tenants appear to have difficulty covering their rent. So many large tenants seem to be struggling sufficiently that they can cover rent, but it's getting to the point of difficulty and getting to the point, quite frankly, of concern for the investor here in Medical Properties Trust. Wrap this up, what does it mean? It means even though they've navigated things successfully, when you look at what happens to Prospect now, it means that they are just beginning, I think, to face the challenges that they have with their tenants. And while they have been able to navigate issues, say around Squibb in the past, it is going to hit them if several of their tenants begin to fail. If several of the larger tenants have difficulties, it means that the funds from operations will take substantial hits, and it will push, I think, Medical Properties Trust into a position where the dividend could be at risk. So even though it's well covered now, it may not be well covered in the face of increasing issues and increasing challenges with big tenants. Okay, so what are the prospects here for Medical Properties Trust? Well, they've been very successful in the past, and I think they actually still have the opportunity here to do very well. If they do actually manage to recover from the challenges with Prospect, that actually does mean that their funds from operations per share are still going to grow in the 2023 financial year. Now, I think it's pretty good overall considering the difficulties across the sector and within this industry. They've got track record here, think about Steward, they've got track record of managing through these issues, and management appears to be confident overall about what they're doing and how they're managing, as well as the opportunity for the tenants. Now, if we look here at the commentary by the Chief Executive Officer, for instance, we can begin to get a sense for how they're doing. So they find that the outlook for the tenants is extremely encouraging on all fronts. Comments from US operators confirm overall optimism about the industry. For example, the staffing costs are becoming more manageable. They're having more success in managing to find key staff such as nurses at reasonable labour costs. And so there's some, definitely some improvements here. So contract labour costs peaked and have come down approximately 33%. Now that means that the operators are going to be less stressed financially, more able to operate effectively. When we go on a little bit further, moving into 2023, the prognosis for margin improvement, which is really important across the overall industry and increasing volume, has also been very encouraging as well. The operators, their tenants, are experiencing low to mid-single digit revenue increases, which is really important to see as well, particularly when you consider the substantial cost increases they've had, and that is going to be valuable to them. So they say, look, 2023 is going to be an attractive year for their tenants, and I think overall that's important to keep in mind also. Now, before we go further, my friends, do please remember to hit subscribe and smash that like button, because you will learn more about dividend investing. You'll be getting more news, more updates, and more security that what you're doing well. So stay with me, my friends, as we learn more about dividend investing. So, if Medical Properties Trust's assessment of their tenants' opportunities in 2023 is correct, and we avoid a serious economic recession, then we may be seeing MPW here very much at the bottom of the trail here in terms of some of the difficulties with share price as well as tenant distress. And that could be here 2023 as a really great year to pick up the shares at a lower price, as there's still this elevated level of risk. Now, it's also important to note a really positive thing here is they have continued to reduce exposure to their biggest tenant, Steward. They've recently announced, for example, that a subsidiary of Common Spirit will take over some of the Utah operations from Steward, and that again reduces the overall exposure that Medical Properties Trust has to Steward. Now, this, of course, is really important because it reduces the concentration risk and the challenges to the company if a single tenant fails. Now, what does all of this mean in terms of their finances and what the impact it's going to have on us as investors? I've pulled up here data on the ticker terminal back from 2010 with estimates out to 2027. So what we're looking at here in first of all, in green is the adjusted funds from operations. So essentially this is sort of their the earnings available for distribution. Now we can see when we add on the blue that the dividends per share have been increasing quite strongly up until 2021. They're expected to sort of level off over the next several years as we begin to see the impact from the challenges that they're having with tenants. And what we're beginning to see here as well then as it's leveling off here, and we expect to see it begin to increase again in the future. But certainly at the moment we're beginning to see the impact here of the 2020 pandemic, The adjusted funds from operations is beginning to decrease here, with a strong expected decrease here in the 2023 financial year, so keep an eye out for that. That will materially, I think, impact the share prices as that eventuates. With some anticipation here of relatively flat adjusted funds from operation, I think, over the next 3 or 4 years, also as they work through a lot of the challenges with some of their more challenging tenants. Now, what that means is the dividends will probably not be increasing as quickly as we might hope, but there is still light at the end of the tunnel, my friends. So look, Medical Properties Trust is certainly not low risk. There are challenges here that we need to be aware of. I've highlighted some of those key challenges based on the latest update. Do take care and keep and monitor the tenant issues very, very carefully. Monitor what's happening to those rents. Watch if the rents are deferred or being written off, and that's going to be the key there to what is happening to the FFO, the funds from operation, in the future. Now, you will need to make sure that those funds from operation are not decreasing so much that they're going to threaten the dividend if you're an income investor. That will be absolutely vital. It's certainly a very speculative stock still at this point, but still at the right price, I think it is a good buy. And certainly when we begin to look at the portfolio mix, it is still a reasonable. And now for a special news announcement. CNH Industrial has raised their dividend by almost 1/3, so a very, very strong dividend increase. And despite all of the inflationary problems and difficulties that they have been having, they are anticipating perhaps and guiding for perhaps even a near 10% increase in sales in the next financial year. Now, this strong increase in the dividend gives them quite a healthy forward dividend yield of just over 2% and some future strong prospects here for dividend growth.